You walk into a coffee shop. You order a latte. You tap your card. $4.50 disappears from your account and appears in theirs. Simple transaction, right? Except here's what actually happened in that moment. No money moved. Nothing was transferred. Instead, something was created out of thin air by a corporation you've never heard of. And the thing that was created wasn't even real. At least, not in the way you think it is. Most people believe money is created by governments, by central banks, by printing presses running in secure facilities with armed guards. And sure, that happens, but that accounts for less than 3% of all the money in existence. The other 97%? That's created by regular banks, every single day, in the exact moment you swipe your card, take out a loan, or sign a mortgage. And the system that allows this to happen is so strange, so counterintuitive, that even people who work inside it struggle to explain it without sounding insane. So let's break it down, because once you see how money is actually created, you can't unsee it, and you start to notice the cracks. Let's rewind. You're back at the coffee shop, you tap your card, the payment goes through. Here's what you think happened. You had money in your bank account. The bank held on to that money for you, like a vault. When you paid, the bank moved your money to the coffee shop's account. Clean transfer. One account goes down, another goes up. That's the story we're all taught. That's the mental model we carry around. But it's wrong. Your bank doesn't have your money. It never did. When you deposited your paycheck, the bank didn't put it in a safe with your name on it. It didn't keep it liquid waiting for you to spend it. Instead, it did something much stranger. It created a number, a digital entry, a promise. That number represents your balance, but the actual dollars you deposited, those are long gone, lent out, invested, leveraged, used to create more numbers in more accounts. When you swipe your card, no physical money moves, no vault opens. Instead, your bank reduces the number in your account by $4.50 and increases the number in the coffee shop's account by $4.50. 2 ledger entries. That's it. But here's where it gets weird. When you took out a loan to buy a car last year, your bank didn't take money from someone else's account to give you. It didn't pull from reserves. It didn't check if it had enough cash on hand. It just created the money, typed it into existence. 1 second, that money didn't exist. The next second, it did. This isn't a conspiracy theory. This is how the system works. It's called fractional reserve banking, and it's been the foundation of modern finance for over a century. Let's walk through it step by step, because the mechanics are both simple and completely absurd. You deposit $1,000 into your checking account. The bank now owes you $1,000. That's a liability for them. But they also have your $1,000 as an asset. So far, so good. Now, here's the move. The bank is required by law to keep a fraction of that deposit in reserve. In the US, that fraction used to be 10%, so they'd keep $100 and could lend out $900. But in March of 2020, the Federal Reserve dropped the reserve requirement to 0. That's not a typo. 0%. Meaning, technically, banks can lend out everything. They don't have to hold anything back. But let's stick with the old 10% rule because it makes the math clearer. You deposit $1,000, the bank keeps $100, lends out $900 to someone else. That second bank now keeps $90, lends out $810, and so on. Each time money gets deposited and lent out, new money enters the system. Your original $1,000 turns into $10,000 in total deposits across the banking system. This is called the money multiplier effect. But notice what just happened. The banks didn't print anything. The government didn't authorize anything. $1,000 became $10,000 through accounting, through promises stacked on promises. Every loan creates a deposit. Every deposit can be lent again. The system feeds itself. And it works fine as long as everyone doesn't try to take their money out at the same time. Because if they did, the banks wouldn't have it. They'd have 10%, maybe less, maybe nothing depending on the year. This is why bank runs are so catastrophic, not because banks are robbed of money, but because the money was never fully there to begin with. Now, let's zoom out and look at the numbers. According to the Federal Reserve, there's about $2 trillion in physical currency in circulation in the United States right now. Bills and coins, actual money you can hold. But the total money supply, what economists call M2, is around $21 trillion. That includes checking accounts, savings accounts, money market funds, the money people think they have. That means roughly 90% of all dollars exist only as numbers in computer systems. They were created by banks making loans, not by the government, not by the Fed printing cash, by banks typing. And here's the part that makes your brain itch. When you pay off a loan, that money disappears. It's destroyed. It goes back out of existence. The bank reduces your debt, reduces your deposit balance, and the money supply shrinks. Money in this system isn't a static thing. It's constantly being created and destroyed, expanding and contracting, based on how much people are borrowing and how much they're paying back. During a boom, everyone's borrowing. New businesses, new homes, new cars. The money supply explodes. During a bust, people pay down debt, default on loans, stop borrowing. The money supply collapses. And that collapse doesn't just hurt the people who borrowed too much, it hurts everyone. Because in a debt-based money system, less money means less spending, means less economic activity, means fewer jobs, means more defaults, means even less money. It spirals. This is why central banks freak out during recessions. It's not just about jobs or GDP, it's about keeping the money supply from imploding. Because if it does, the whole system seizes up. Now here's the irony. We talk about money like it's this solid, dependable thing. We save it, we budget it, we stress about it. Politicians argue about it. We measure entire economies with it. But the money we're talking about is mostly fictional. It exists because we agree it exists. It has value because we believe it has value. And it's created by institutions whose job isn't to serve the public, but to maximize profit for shareholders. Banks aren't neutral. They're not public utilities. They're businesses. And the power to create money, which used to belong exclusively to governments, is now mostly in private hands. When you take out a mortgage, the bank doesn't check with Congress. It doesn't need permission from voters. It just runs your credit, checks the collateral, and creates $250,000 with a few keystrokes. That's an enormous amount of power, and it's largely unaccountable. Sure, banks are regulated. There are capital requirements, stress tests, oversight, but the core mechanism, the ability to create money through lending, that's just part of the system. It's normal. And for a long time, it worked. Credit expanded, economies grew, living standards rose, the system delivered. But it also created fragility, because when money is debt and debt is money, the system depends on perpetual growth. It depends on people always borrowing more, always spending more, always believing the numbers in their account are real. The moment that belief cracks, everything unravels faster than anyone expects. Swipe your card, money is created, and somewhere in a system too big to see and too complex to stop, the clock keeps ticking.